Before you watch one more second, you need to know this. There are only 3 forces worldwide that determine if you'll ever buy an affordable house. 3 invisible economic giants that have worked together in a perfect storm to make house prices explode everywhere on Earth. You've heard for years that it's the fault of political laws and regulations, or perhaps the increasing population pressure. But that's only half the story. In this video, I dissect the 3 universal economic laws that have the housing market in their grip, and you'll discover who truly sets the price of your dream home. This is the most detailed and understandable explanation you will ever see. What we're giving you today are the universal core principles, the fundamental engine behind every housing market worldwide. Be aware that local factors such as the laws, regulations, and demographic growth can accelerate or slow down the price explosion. But the 3 giants we're about to discuss are the basis of the current problem. Keep watching because the 3rd factor is the most shocking of all.
The first giant, the price of time, the interest rate.
Let's start with the absolute basics, the mortgage interest rate. Many see the rate as a number on their loan, but economically speaking, it is the price of time. Interest rate means the compensation you pay for borrowing money or the compensation you receive for lending money. It is the mechanism central banks, such as the American Fed or the European ECB, use to steer the entire economy. For years after the 2008 financial crisis and later during the COVID pandemic, central banks kept the interest rate artificially low. What happened then? Analogy of the interest rate lever. Imagine the interest rate is the money tap. When the rate was extremely low, that tap was wide open. Money flooded the market at near zero cost. This had 2 gigantic effects on house prices everywhere. It increased the buying power, and the alternative vanished. Let's start by looking at the increased buying power. Increased buying power. This is crucial to understand. The bank calculates how much you can pay per month. Let's take a simple example. Although we use the euro for this example, the principle is universally applicable to the US dollar, the British pound, or any other major currency. Assume you can afford a maximum of 1,500 euros per month. When the interest rate was 5%, for that same 1,500 euros, you might have gotten a mortgage of 250,000 euros. When the interest rate dropped to 2% with the exact same monthly payment of 1,500 euros, you could suddenly take out a mortgage of 400,000 euros. This is a huge difference in your maximum loan. You could simply borrow more for the same money. And if millions of people can bid more at the same time, what happens to the price of the house everyone is bidding on? The price goes up. The low interest rate increased the buying power of millions of people simultaneously, artificially inflating demand. This created a demand-driven inflation on the housing market. The alternative vanished. If saving yields nothing because the savings rate was 0, real estate is one of the few places left where you can park your money for a return. This brings us to the next term, opportunity cost. This is the missed return from the best alternative that you did not choose. The opportunity cost of not investing in real estate became too high. Why leave your money in the bank for 0% if you can put it into property and earn a return? This transformed the housing market from a place to live to a place to invest. The counter movement, rates up. Since the recent inflation crisis, central banks have drastically flipped to the lever. The money tap is now nearly shut. Suddenly, borrowing becomes expensive. This is the economic reason why you see prices flattening or even dropping in many countries. Buyers simply can't afford to pay as much anymore. The interest rate is thus the most direct and universal determinant of the house price.
The second giant, the limit of the planet. The scarcity.
The second giant is simple, but devastating. Absolute scarcity. Scarcity is the fundamental economic problem where resources, such as land or houses, are limited in relation to unlimited wants and needs. In contrast to almost every other product in the economy, real estate has an imperfectly elastic supply. That means that the quantity available, the supply, hardly or does not react to a price change. Even if the price of a house doubles, you can't just double construction because you're dealing with three unique obstacles. The raw material is finite. Especially in popular cities and urban regions, you simply cannot create new land. Demand concentrates in the economic centers, the places where the jobs and opportunities are. This creates a geographical scarcity that cannot be solved. Even if you start building in the desert, the demand for homes near the best schools or largest technology centers is infinite, while the space is not. The construction cycle is long. A factory can double t-shirt production in a few weeks. Building a house takes, with planning and permits, at least 2 to 5 years. By the time you answer today's market demand with new construction, the economy has already changed again. This slowness is a universal problem. Construction simply cannot keep up with the rapid fluctuations in demand caused by the interest rate. The rental market leakage, the alternative shortage, the scarcity is not only in the buying market. Everywhere you look, the free rental market has shrunk. Why? Because it's often more attractive for investors to sell homes to other investors, or because new regulations make building rental homes unattractive. When the rental market is tight, people are forced to buy. This shifts demand from the rental market directly to the buying market, pushing prices up even further there. This is the universal effect of a disturbed housing supply.
The third giant, the search for safety, capital flows. This is the most misunderstood factor and the reason why house prices are decoupled from the average income. It's about capital flows. A capital flow is a large stream of capital, for example, savings or money from pension funds, moving from uncertainty to certainty, the housing market. A house is no longer just a roof over your head. It is a financial asset. In the modern globalized economy, investors, big and small, are looking everywhere in the world for a safe haven for their assets. And what is safer than a physical piece of ground that cannot disappear? The analogy of the disaster insurance. Real estate is the ultimate disaster insurance for wealth. Flight from inflation. When inflation worldwide exploded in 2022-2023, investors became afraid that their cash would lose its value. Where do they flee? To assets that move with inflation. House prices often rise along with inflation, making real estate an attractive inflation hedge was/is. This applies to wealthy individuals, but also to large global pension funds. Their decisions in New York or London directly influence demand in Amsterdam or Antwerp. The investor's return. Investors do not have to base their bid on a modal salary. They base it on the return the house can yield. Return is the total profit gained on an investment over a specific period, expressed as a percentage. As long as the expected rental revenues plus the appreciation of the house, the return, is higher than what they can earn with a bank account, investors will continue to buy. They buy with the thought that they can rent it out more expensively later or sell it at a profit to the next generation. This creates a double demand for every house that comes onto the market, one from the buyer who wants to live and one from the buyer who wants to invest. And the investor often has the financial clout to make the highest bid. This invisible struggle between living and investing is the third universal factor that drives prices skyward.
Conclusion: the unavoidable reality. So, we've now seen that these three factors have the greatest influence on the housing market. It's not a conspiracy, it's economics. House prices everywhere in the world are driven by the dangerous combination of these three factors: the interest rate, central banks determine how expensive borrowing money is, the scarcity, the physical limit of the land, and the slow construction cycle, the capital flow, the worldwide search for a safe investment that drives up the housing market. To possibly protect yourself against these forces, you must understand one thing. You can't time the market. You can only strengthen your own financial position through smart savings decisions and by focusing on the long term, instead of daily price fluctuations. If you understand these three forces, you've cracked the code.
The ultimate test. Let us know what you think of this analysis below. Answer in the comments. How does an interest rate reduction, as in the example, directly affect your maximum borrowing capacity? Which economic concept describes the situation where the construction cycle, 2 to 5 years, is too slow to quickly respond to demand? The capital flow creates a double demand for every house. Which struggle is caused by this?